Welcome to CPE Voices, our new series through which we'll be presenting insightful discussions among industry thought leaders, moderated by our editorial team. We kick off our series with a mid-year outlook for the commercial real estate industry, addressing issues ranging from the supply chain to the Great Resignation to the capital markets. I'm Suzanne Silverman, Editorial Director of Commercial Property Executive, and I'm here today with Mark Zandi, Chief Economist with Moody's Analytics, Heidi Learner, Commercial Real Estate Economist and Quantitative Investment Strategist, Simon Lauzier, Chief Financial and Business Performance Officer for Ivanhoe Cambridge, and Jeb Belford, Managing Director and Chief Investment Officer with Clarion Partners. We are recording this session and it will be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar in the Q&A window. And thank you to those of us who submitted some in advance. We'll try to get to as many as possible. We'll kick off today's discussion with an economic forecast from Mark, followed by a real estate forecast from Heidi. Mark, take it away.
Thank you, Suzanne. It's good to be with you. And I want to thank you for the opportunity and the 3 hours to speak. Very kind of you. No, nothing worse than an economist for more than just a few minutes. And I'm sure top of mind for folks is, are we going to experience a recession in the next year or two? And I think the risks are high. It's pretty clear that the risks are uncomfortably high, but I think odds are still that the economy will navigate through without suffering an economic downturn, that the economic recovery from the pandemic will evolve into a self-sustaining economic expansion. And what I mean by that is that the economy will be at full employment, if it's not already there, this summer, and that inflation, which obviously is very painfully high, will moderate. Just to give you a number, consumer price inflation, CPI inflation in the first quarter of this year, year over year, was up 8%. That's probably the peak. I expect it to be closer to 5% by the end of the year, excuse me, and closer to the Fed's target, which for CPI is about 2.5% as we make our way into 2024. So take a bit of time, but I think we'll get there. Three key assumptions behind that, let's call it sanguine economic outlook. First, that the pandemic continues to fade. What I mean by that is not that there won't be additional waves of the virus, there certainly will be, but that each wave will be less disruptive to the economy than the previous one. Feels like that's what's been happening. Omicron's been somewhat disruptive, particularly to China, but that was did less damage than Delta, which did less damage than Alpha. And the thing that hit us at the beginning of all this a little over a couple of years ago. We're getting better as business people and as consumers to navigate around the virus. And the virus does feel like it's becoming less virulent as it goes forward. But that's a key assumption, key to global supply chains and labor markets. Second key assumption is that the worst of the economic fallout from the Russian invasion of Ukraine, which obviously feels like that's going to go on for a while, but the worst of the fallout is at hand. I think the benchmark for that would be oil prices. They're sitting at around $120 per barrel. I expect that to be roughly the peak. That reflects the recent decision by the European Union to sanction Russian oil. Feels like at this point, any country or region that's going to sanction has done so. And going forward, given these high prices, we should see more supplies come in. There's just a lot of money to be made. So I expect oil to be closer to $100 a barrel as we make our way into next year, and then closer to 80, 90 bucks a barrel as we make our way into 2024. And the third key assumption is that the Federal Reserve is able to manage policy deftly. That means raise interest rates high enough, fast enough to slow growth so that the economy doesn't overshoot full employment and exacerbate the inflationary pressures, but doesn't raise rates so far, so fast that it pushes the economy into recession. Obviously, a lot of risk around that. And that goes to the recession scenario. You can see there's a very high probability, as I said, uncomfortably high probability that this doesn't play out as I anticipate and we suffer an economic downturn. I will say, if we do suffer a downturn, I suspect that it would be a relatively modest downturn. Just to give you context, a typical economic recession in the last 6 to 9 months, GDP falls a couple percentage points peak to trough. In the current context, employment would fall about 3%, 3 million jobs, and unemployment would rise to about 6%. Feels like if we do suffer a recession, it'll be something less severe than that. The fundamentals, what I consider to be the fundamentals of the economy, are good. The balance sheet of American households, businesses, the financial system feel like they're in pretty good shape, unlike ahead of previous economic recession. So recession risks are high, but I think that a downturn should be relatively short-lived and not as severe. Just to round things out, obviously there's other risks on the other side of the distribution of possible outcomes. You can see I attach very low probabilities to a stagflation scenario. That would be pretty dark. That's because that would be a policy mistake by the Federal Reserve. And given the way the Fed is operating now and what Chair Powell has been saying, that feels very unlikely, but possible. And then finally, just end on a more positive note, I do think there are some very positive developments on the supply side of the economy. Obviously, in a broad sense, the economy is really struggling today because it got hit by two massive supply shocks, the pandemic and the Russian invasion. But there are some good things that are happening on the supply side and related to productivity gains. I think remote work is game changing here to stay, and we'll have productivity enhancing benefits. And I do expect stronger foreign immigration going forward. So things could, again, low probability, turn out better than I anticipate. But bottom line, the next year or two are going to be a bit uncomfortable, but I think at the end of the day, we'll be able to navigate through without suffering an economic downturn. With that, I'll stop, Susan, and turn it back to you.
Okay, well, thanks so much, Mark. Heidi, I'll turn things over to you for the real estate forecast.
Great, thanks so much, and thanks for inviting me here today. And we just heard from Mark about the low probability of a stagflation scenario, but that doesn't mean that inflation pressures won't remain elevated and above 2% for quite some time. And I'd note that even the Fed still sees core inflation and headline inflation as measured by PCE still above 2% by the end of 2024. My comments here are based on using NCREIF's NPI return series as the benchmark for commercial real estate returns. And what we see is that total returns have historically been correlated with nominal GDP rather than real GDP. And we can see just how much inflation has affected nominal GDP on the table on the right-hand side. And note the difference in nominal and real returns. And this is true whether it's been over the last 2 quarters or 2021, or even looking ahead at the Fed's most recent forecast for 2022. So in this context, I think we could see high single-digit, low double-digit total returns for this year. If we flip to the next page, I would say if I had to emphasize one message, it's going to be that there's likely to be real divergence by sector and by geography, with inflation likely to have disparate effects depending on the degree of pricing power that landlords have. And it's unlikely that we'll see rents on new leases climb nearly as much as they did last year. I'd make 3 points about the tables here on the left-hand side. The first is that over the longer term, returns are more correlated with headline CPI than core CPI, and more correlated with CPI than PCE. I'd also point out that inflation is more correlated with total returns than capital returns. And I'd also point out that correlations vary by sector pretty significantly and aren't necessarily in line with what one might think. And as an example, we can think of hotels as essentially having nightly or maybe 1-week lease terms with their tenants. And yet their ability to grow NOI in line with inflation has really been the weakest of all sectors. And while the tables on the left-hand side show the correlation between inflation and returns over the last 40 years, the chart on the upper right shows that on a rolling basis, correlations can vary greatly over time, with correlations particularly high over the most recent 5 years as inflation has risen. We turn to the next slide. I'll conclude with just a few comments on 2 sectors in particular, office and industrial. And in office, I'm afraid I still have a gloomy outlook, particularly given that the bulk of employment gains in the cycle have likely been achieved. And we've already begun to hear about a slowing in the pace of tech hiring or even outright hiring freezes from the likes of Intel and Tesla and Meta and Uber. Office vacancy rates were still higher in the first quarter of 2022 than in Q1 of 2021 for a number of metros, including high-performing metros like Atlanta, Tampa, and Phoenix, for example. And even with metros that have still seen significant gains in the total number of office-using employment jobs from pre-pandemic levels, and here I'm measuring from Q4 2019 to Q1 2022, in many cases, there's been little increase in the amount of space that firms occupy. I point out that nationally, the office worker count is up by 2.2% from pre-pandemic levels, but the amount of space that's occupied has shrunk by 2.6% over the same time period, for example. And even in a place like Raleigh, where employment is up almost 11% from pre-pandemic levels, so pretty significant, the amount of space that firms in Raleigh occupy has barely budged. So even without a recession, a likely slowdown in activity is apt to mean that the office sector is going to continue to lag from a performance perspective, especially as many of the projects that were started right before the pandemic are just nearing completion now. And on the next slide, I'll conclude here with just a main point that I'd like to make about a continued divergence in office and industrial performance. And you can really see this emerging over the past 2 years. And this is true even if the pace of growth and industrial occupancy, which is clearly at very elevated levels, begins to slow. And that's something that we could anticipate, particularly given that bellwether Amazon has acknowledged as much with regard to its warehouse occupancy. And we hear from companies like Target that have announced steps to reduce their excess inventory. I'll end here with just a comment on geography, that the best returning office market by MSA in the first quarter was San Diego. Office markets there had a total return of 8.1%. But if we look across the industrial complex, of the 46 MSAs that NACREIF covers there, almost 2/3 of them had higher returns than the best performing office market in the entire US. So I do think that dispersion in returns is likely going to be the name of the game for the balance of the year. And with that, I'll turn it back to you, Suzanne.
Thanks so much, Heidi. Simon and Jeb, let's hear about the investment perspectives on all of this. Are you making changes to your investment strategies to adapt to these economic shifts? Simon, I'll ask you first.
Yeah, thank you, Suzanne. Thanks for everyone for joining. It's a great discussion and a very interesting time. To answer your question, I would say we are staying the course. We are not changing our strategy, but obviously we know there's going to be some bumps along the way. The context is very challenging, but the portfolio we have built is reacting very well for now. And just to give you an idea, Ivanhoe Cambridge, we have a portfolio of $55 billion. It's a global portfolio, well diversified. And over the past few years, we embarked on a major pivot for more from our traditional asset class, such as office and retail, to shift more into the residential and logistics and increase exposure there. We've created platforms also to be able to manufacture our own transactions, also on the dev and redevelopment opportunities, making our returns a bit more predictable and building resilience. And I would say on the shift, economic shift that we're seeing right now, it's very interesting. And what has surprised me is not necessarily the rate increase that we knew we were going to face along with a bit of inflation, but it's really the speed at which it has taken place. And we often forget, but it always plays out about the same with the capital markets reacting. In this case, we've seen AAA spreads increasing or widening by more than 50 basis points. Everybody stopped the deals they were doing. And I think there's a lot of wait and see right now. And I think Mark said it well in the intro. We're waiting to see what the scenario will be. Is it between the soft landing or stagflation? definitely interesting to see what the reaction has been with a bit of a halt right now.
Okay, and Jeb, what about you?
Good afternoon, everybody, and thanks for everybody participating, and thanks for having me here as well. I would echo a lot of what Simon just said. We tend to think about investing in long-term trends, and we had already, well before, had shifted our strategy to favor what we thought were the stronger property types, industrial and housing, and away a bunch from retail and even office. Although we certainly, no one could have predicted how the pandemic was going to affect the office sector. But to the extent that we were already investing along those lines, that has turned out to have exacerbated COVID in the same direction. So at the moment, we have not seen much of a reason to shift our strategy. We're maintaining focus on the sectors that we think look the strongest and have the fundamentals, logistics and housing, and are very cautious about retail and office. And we could also add in a whole bunch of the other smaller or more niche property types, that some of which look amazingly good, with very good fundamentals, and others of which look more suspect. So we have not seen a real reason to shift our strategy. We could also layer in all sorts of geographic elements of this too, that I think we may get to. But I will say that the pandemic has sharpened certain trends and made it all the more important to look at what's happening and stay on the strategy that you think is the best.
Okay, thank you. Before we talk in more depth about the outlook for investment, let's take a look at some of the biggest trends impacting the commercial real estate market. There's been a lot written about the Great Resignation, the huge number of people that have just rethought their lives and left the job market during COVID. Is that a long-term trend, or do you see the vast majority of those who left reconsidering their decision as some sort of normalcy returns, inflation drives prices up, and they have to pay their bills? Mark, could I direct that to you first?
Sure. Well, I think we will see some normalization in the number of people that are quitting their jobs as the pandemic continues to fade. I think what happened was, when the economy reopened about a year ago, when the vaccines were rolled out, it felt like every business in the country put up a help wanted sign at the same time. And given all of the unfilled positions, the record number of unfilled positions of well over 11 million, that provided a significant opportunity for people to find a better job, pay better, shorter commute, childcare issues, better boss, that kind of thing. That continues to this day. You continue to see people quitting jobs at a relatively high rate because the labor market's been so tight because of the pandemic and all the unfilled positions. You also saw a lot of folks my age retire early. They were going to retire anyway in a few years, and because the pandemic hit, they decided this was a time to do it. But looking forward, as the pandemic winds down and inflation is high and people are burning through any excess saving they built up during the pandemic, and I think labor demand is going to weaken. As I think Heidi pointed out, you're starting to hear more businesses talk about layoffs. I think we'll see those unfilled positions taken away. I think the number of people quitting their jobs will decline. The other thing that will happen is that typically people who retire, they tend to come back into the labor force because of economic need or just lifestyle. And so that'll affect the labor market too. But having said that, and then I'll stop, I do think the rate at which people quit jobs will be more elevated going forward compared to what it was pre-pandemic. And that goes back to remote work. I do think people, because they are working remotely, and I do think there's no holding this back. This is going to happen as the technology continues to improve and as businesses optimize around remote work. that it just makes the labor force more fluid. People can take another job very easily. I'm like, it's not only here in the US, I could get a knock on the door, proverbial door in LinkedIn from a company in Paris or Singapore or Dubai, and it makes it much easier to move. So I think quit rates, the number of people leaving their jobs, will remain elevated. It'll come in compared to what we've seen over the past year, but it's not coming all the way back in.
Okay. Generally speaking, to bring this into real estate, and Heidi, maybe I'll direct this one to you. How much of an impact do you expect the Great Resignation to have on the real estate industry?
A great question. I think the largest impact is really going to be to what extent employers have to make remote work accommodations in order to draw people back into the labor force, or what power certain industries have on making full-time on-site work a must. I think most employers are now offering a hybrid environment, maybe save Tesla, which makes the ability of office, or maybe the importance of offices serving as a gathering space and a collaboration space, that much more important rather than a place to do solo work. So I think the impact on real estate, certainly we've felt it today on the office sector. I think it will continue to weigh on the office sector, but I really do think it reshapes how one thinks about the office and then the physical layout of the office to really encourage more connectivity, because as we've all seen, a lot of individual work can be performed just as well at home.
Do you anticipate? Sure, go ahead.
Sorry to interrupt you there, but I was just going to comment on top of that, my opinion is that we're going to see companies do lots of different things, and some are going to remain very accommodative because that is what will attract the best employees for them. But there are going to be other places where I think it reverts back, and I don't think we've yet seen all the dynamics that are going to drive that. I think on a personal level, if people, they're going to fall behind by being more remote than other colleagues that are in the office, I think there's a good chance that for a bunch of people that's going to change their behavior and move them back into the office. And similarly, if you have a company that all of a sudden realizes that they're losing ground competitively to someone else whose people are back in the office, that might change behavior relatively quickly too. So I think we have to keep our eyes open as to some of those dynamics that I don't think have yet really played out as to how people really, employers and employees react to office. My personal see all sorts of different things from different industries and different companies, and how that all adds up, we're gonna have to watch and wait and see.
Yeah, Jeb, do you, it is early on still, but do you anticipate any significant shifts that could impact the types of space that will be in most demand?
For sure. One of the things that we're seeing right now, for example, in a couple cities, are brand new buildings that are being built. You might sit there and say, well, why would you build a brand new building right now when the office market is weak? But some of these projects have been underway. Some of those new buildings are for sure marketing themselves as the office of the future, like healthy, great layouts, all the light and air and amenities that tenants will want. And so far they've been quite successful in attracting tenants at extremely significantly higher rents than other office space. So new space that can market it as sort of the building of future, I think, is going to be something we see and see more of. Will it really be terribly different inside than another office building? From a dramatic point of view, I don't think so. But there will be a real demand for what's perceived to be that highest quality, most healthy space going forward.
Okay, now on a related note, during the pandemic, there was a lot of movement away from major metros to secondary and tertiary markets. Some people have returned, a good many have not. What's your expectation on a return to primary cities? Do you think an economic downturn would bring people back to the major metropolitan areas? And Mark, maybe we'll start with you on that one.
Well, my view here is similar to my view on remote work. There'll be some swinging back of the pendulum, but there's no going back. I think that applies to big cities. We'll see some return to the bigger cities, particularly by younger people. But I don't think I think these larger cities are going to be much diminished by what's going on. We get just some data based on credit files that we get from Equifax every month, and we can see this at a consumer level, a household level, and we can see address changes. It's anonymized, but we can see movements. And through the very timely, so I have data now through the month of May, and the net out migration of people from urban cores to suburbs, exurbs, rural areas is still very elevated compared to what it was pre-pandemic. It's come in a little bit from a year ago. It peaked a year ago, but it's still very high. The thing that is reversing is folks in their 20s and early 30s. They appear to be returning to the big cities. Folks that are prime age, working, 30s, late 30s, 40s, and 50s, they continue to leave at a very prodigious rate. There's no slowing there yet. And it really is diminishing the big urban centers in the Northeast. New York is the poster child, but Philly, my hometown, DC, Boston, Baltimore, Chicago, and then on the West Coast, the obvious, the Bay Area, LA, Seattle to some degree are being hit hard. So those flows continue. And I think that pendulum will swing back some more here as office towers and CEOs of companies say, hey, you got to come back. But I don't think there's any going back here. This is here to stay, and it'll slowly start rising again as we look towards the end of the decade into the next decade.
I just that once again that a lot of the trends that we're seeing didn't start in COVID, right? They actually started well before COVID, and they've been playing out for a long period of time now. It may have exacerbated all sorts of things, and especially perhaps removed from the inner city part out to more of the suburbs. Although you could argue that was going to happen anyway because as the millennials aged. But the trends that we're seeing have been in place for a long time. We're seeing an acceleration of them, and I would tend to agree with Mark that you're going to see some people moving back in, but I don't think we're going to get a shift.
Okay, let's look a bit at the major commercial property types. The industrial sector has gotten so hot during the COVID years, and Heidi, you touched on this earlier. It's attracted institutions to invest that previously considered the deals too small. Do you think it's going to stay hot? Simon, why don't we start with you?
Look, I think the sector is definitely hot. We're looking obviously at the demand and supply. I would say for the next 2 to 3 years, it's pretty clear that there's a lack of supply in lots of major markets. And we've seen lots of growth in that sector. And again, just to quote some Green Street data, I think the top line has been growing 18% last year. They revised this year at another 18%, and then it's slowly gonna slow down in the next few years. But it's rare to see that you're able to grow the top line, between a 7 to an 8% CAGR. And I think that's what's attracting investors such as ourselves. And if you look at all the supply chain and what's going on with the crisis we're going through, many people are planning for what they call the China plus one, or having some other alternative source for their chain of production and so on. So I think we're going to probably see additional needs or supply being built to address that demand. And I know that there's been lots of Amazon talk and discussions, but there are many users waiting on the sideline, the 3PLs, for example, to take on that space. So we think it's a good sector. And again, the key, just like Heidi mentioned, is going to be about being able to convert those very aggressive going-in cap rates and marking them to market. So shorter lease terms are favored. And again, there's also some good land assembly development taking place where you can potentially build to a 5 to 6% yield on cost. and given the cap rates that are around the 3 or the 4s, it still makes sense. So it's still a good sector, and it will keep attracting players, I think, for the next few years.
Hey, how about on the office side? We've already talked about how it's been challenged by work from home. Will the economy deal a new blow to the sector just as workers are starting to return to the office? And Jeb, you made some comments earlier about how employees or companies may feel some competitive pressure, and certainly that may have an effect as time goes on. In the nearer term, is the economy likely to shift things one way or the other? Heidi, do you have any opinions on that?
I think, unfortunately, a lot of employers who anticipated at this point that more workers would be in the office by now, they've been disappointed. And in fact, for anyone who hasn't seen today, there's a great New York Times article that's out that basically asks the question, when are people coming back? And the answer is somewhat never, because employees are really having some bargaining power. I don't think anything from an economic perspective is really going to alter the landscape one way or the other. I think we've all commented that employment growth seems to be slowing, or at least maybe we've seen peak growth, hopefully the same way that we've seen peak growth in inflation. But I certainly don't think anything looking ahead is going to be broadly that much more supportive. I don't think at this point people's in-office plans are really being affected by the trajectory of COVID. And most employers have really resigned themselves, for the most part, to a hybrid strategy.
Can I jump in on one very important macro trend that, to Jeb's point, was in place well before the pandemic, but it's going to become painfully obvious for the office market, is the working age population is slowing very rapidly. And the number of jobs that actually can be supported by the working age population is going to slow very substantively. So we're all used to pre-pandemic a normal gain in employment each month of 150 to 200,000 jobs. Going forward in the not too distant future, I'd say by mid-decade, typical will be at most 50,000 jobs. And that's all jobs. That's construction, that's manufacturing, and office using. And that just goes to the aging of the population, and boomers retiring out, and much less immigration going forward. So I think the office market has a very significant challenge when it comes to absorption. It's going to be a lot slower in the next 10, 20, 25 years than it's been in the last 50 years. Pandemic aside, pandemic and remote work aside.
Yeah, and we would echo that those long-term demographic forces are incredibly critical to our space. And I think we've all been well aware that the pace of our growth is slowing when it just comes to people. And you come down to it, real estate needs people. And if we're not growing people, you could argue that we don't need to grow ourselves. So we've got to really watch that. I think Mark is very right on that.
I'd love to, I've got more office questions, but why don't we shift now, just watching the time, to talk more broadly about the outlook for the real estate investment market, both equity and debt. And if we have time to go back to office during the Q&A, we could talk some more about that. Or we'll have a whole nother follow-up webinar about it. But let's talk more broadly about the investment market. Simon and Jeb, what's the competition like these days?
Well, let me jump in on that one first, then I'll let Simon say something far more intelligent than I can. But up until this last couple months, when rates spiked, and changed the borrowing costs, I would say it was unbelievably competitive for what everybody was good, which was industrial and housing and some of the smaller property types where the fundamentals are good. The competition was relatively weak for the kind of property types that we're looking worrisome, office and retail, and that's why you've seen just a tremendous amount of industrial and housing transactions over the last couple of years, and you've seen relatively little as far as transaction activity in the sectors that aren't doing as well. But the last months, especially the last month, has changed the landscape again. It has largely caused many people to pause. Deals have been put on hold or canceled. There's been interesting reaction from sellers, either putting properties or not putting properties on the market. But we're a little bit of a pause. Competition at this very is much less. And if you wanted to go, bid on properties that are still on the market, the number of bidders you're against are less at the moment. And we're in another little changing phase. We're going to have to see how that also plays out.
Jeb, very good point. I would say this question would have been answered differently, a few quarters ago. But again, things have changed. I would say that the competition now will probably be more well-capitalized players, given how tight the debt market now is. And I would say with everything going on and what we said earlier, in some cases, on some tighter product like apartments, logistics, and so on, the going-in yield today are below the borrowing cost. And I think that's new for some people, but we've been there before, right? But what it points out to is the ability for those players to be able to underwrite the growth, right? So we're now going back to being very precise at understanding how fast we can grow the rent and get to a very decent IRR. So I think we'll see lots from those bigger, well-capitalized players. And I would say on the logistics side, the trend that we're seeing is platforms that are very well equipped to be able to get the entitlement on their land and go ahead with their plan. Things are moving very fast, and you have to deal with a lot of complexity. And again, trying to make sure that you really understand how much cash flow you're going to be getting, given the very high growth that people are underwriting.
Okay, how is real estate being perceived as an investment relative to other alternatives? Heidi, do you see many non-traditional investors entering the commercial real estate market?
I think what's new this cycle has been the advent of non-traded REITs like Blackstone's BREIT that have really appealed to retail investors in a way that maybe traditional REITs haven't, particularly with traditional REITs, open-ended REITs, having a daily mark-to-market. And I think something like BREIT has been made that much more attractive, at least until recently, by an environment of very, very low yields. And I think perhaps there's going to be some degree of reckoning as we start to see the cost of borrowing increase. But to date, I think one of the most pronounced shifts has really been the entry of a new class of retail investors. And like I said, we've just seen tremendous growth in the non-traded REIT sector.
How active are foreign investors now? Simon, I think you had some thoughts on that.
Yeah, look, I think the volume has been very strong, as you know, up to the first quarter of this year. It slowed down very quickly in April. As a matter of fact, I'm looking at some stats where overall trading activity has been down 16% year over year versus the April 2021. But we're still pretty good year to date, with almost 40% year over year across all the sector. And then if you look at the cross-border transaction, we had some kind of spike in 16. I would say we were getting a similar momentum towards the end of last year, Q4 and Q1 this year. And I would say the concentration is pretty telling. Obviously, lots of Canadian, Korean investor, Bahrain as well, and Singapore with GIC. Again, few of the same players really coming back to invest in the U.S. market. And I think one of the trends that we're seeing is, yes, there's stress everywhere on a global basis, but I think the U.S. is still perceived as a safety place to invest in real estate. So I hope with this, combined with what Heidi mentioned, the wall of capital from non-traded REITs and other sources, will probably be a good resilience factor for the U.S. market. But yes, foreigner seems to be back. At least last quarter and the first quarter this year.
Okay. Jeb, I think you've already said that we've seen some reduction already in investor interest in response to the Fed's rate hikes. Relatively, how much have you seen compared to how much you expect to see? At what point do you anticipate the market settling into something of a clear direction?
Yeah, I guess the way I would say what's happened so far, a lot of people are going on pause, not necessarily going away or changing their fundamental belief on whether the real estate sector is effective, but it's certainly a moment when people have gone on pause. As I pointed out, it's an awful lot harder for higher levered buyers to make sense of transactions, rates with higher borrowing costs. So they've, to some extent, they've been forced to, and for now. But I really don't think the fundamental desirability of our sector is going to diminish relative to other asset classes. So I think that capital is going to remain poised and wanting to invest in our space. But to your question, I think it's going to take a little bit of people thinking there's some more certainty as to where we're all headed in the next 6, 9, 12, 24 months. It feels very certain now. Investors don't like it, but I think we need to settle into the economy is going to play out a little better. We've got to get a little further along. We're really going back to work, in order for people to get more comfortable committing more dollars. And along with that, or even a precursor to that, would be enough of price discovery so that people can feel confident, can underwrite whatever they're going to underwrite relative to that pricing and feel good about it.
How does the M&A market fit into this? After the large volume of mergers in 2021, do you expect more of the same this year as investors strive to place capital? Simon?
Yeah, look, I'll make the
first.
link. Yeah, I will make the link to what Jeb says. It's very difficult right now because everybody's on hold. I was extremely surprised with the REIT pricing across the board being, going down quite quickly, and even in the logistics asset class, we've seen those big drops. I think the REIT market is very correlated, obviously, with the interest rate change. Is it right to be so? I'm not quite sure, because if you look at the underlying real estate, for example, again on the logistics side, then you should get comfortable with the growth that these companies will see. So I think at one point it's really about discount to NAV. When do players start moving in to close that gap? I think we will see some instance of this happening. And again, if we're going back to what has happened, in the last few months, with obviously the non-trading traded REITs playing a more active role, I would not exclude another very active year on the M&A front.
I would just add to that 2021, we saw record M&A activity by REITs. And I think some of that, certainly the non-traded REIT sector has an insatiable need for deal flow. But away from that, I think one thing that could work against very robust M&A activity is potentially this rise in interest rates. So that was part of the reason I think that we saw such a banner year for 2021.
Yeah, I think it's just worth noting that there's generally no shortage that can do M&A activity if they believe it's attractive. And I don't think we should believe any different today. Like, there are plenty of capable investment groups out there that can pull it off if they want to pull it off. So I think I would agree with Heidi. I don't think we're going to see what we saw last year, but there are going to be people trying to take advantage of the situation if they think it is a situation that of.
Okay. And Jeb, have you seen much shift yet in cap rates and pricing based on the interest rates?
We have, and again, it's not consistent across different property types and some geographies. And no surprise for some of the most sought after stuff. Let's go back to something I think Simon said. Industrial properties with short-term leases where you can really get at the market quickly. There's really been very little change in from our point of view. Tons of buyers want that. They're still transacting. Pricing has changed very little. But for long-term duration leased assets, where arguably financing was a little more important to the transaction, cap rates have really, in the net lease sector, which was probably the first to be, quickly affected. Cap rates went up 50 to 100 basis points relatively quickly. Cash relatively certain, which is both a good thing, and in this case, not quite as attractive from a financial point of view. Really moved there quickly. On the apartment side, which is another very active sector, cap rates definitely have moved and still playing out. But again, a very attractive asset class, an asset class that, however, is a little higher financed than some of the other property types. So I think the higher rates have more of an effect there. And we'd probably say for the best apartment assets, the best market, cap rates have moved out probably 25 basis points. And maybe it's gets a little higher than that as you go to smaller markets and a little bit less desirable overall quality of the properties. But cap rates have definitely moved in most places, although not super duper dramatically.
Simon, what kind of financing is currently available both on the debt and equity sides, and how do you see that changing?
Yeah, look, I would say we spoke earlier about the CMBS market. I think spreads or total borrowing costs will probably come back slightly. But what we've seen is that all these big deals being done in the CMBS market are now being done on balance sheet. And I would say in the traditional bank network, they're tightening, obviously, the underwriting. So for apartments, logistics, it's still pretty good. I would say more challenging with office, depending on the lease term that you have, and also on retail. And I would say they're very selective. And from an LTV standpoint, there might be some adjustments. Lots of them are moving to a debt yield approach, so it's going to be more difficult sometimes to clear those hurdles. And I'm also seeing lots of debt fund being raised right now because they're going to come and address that financing gap that we might face. And if you add to this a few cap rate increase on some asset class, I think it becomes interesting to be a mezz lender or be able to play more of a pref equity in transactions. It's definitely something we're looking at. But that's kind of the layout of the market at this stage.
Okay, let's turn now to some questions from the audience and make sure we have some time to answer some of those. Why don't we start by asking how you expect commercial mortgage rates to move during a rate flattener environment? Simon, why don't I direct that one at you?
Yes, Susanna, this is a good one because if we now look at the longer end of the curve, I think things are pretty flat. So I think it's just the floating rates. How will you get there? Do you are you gonna hedge your transaction? And I would say if you go try to fix your transaction today and because you don't want to face that floating increasing rate, you're de facto paying for all these potential rate increase, right? So it's kind of expensive to hedge this because you're buying the full curve, I would say. But I don't really see a change other than the coming back to the normal on the spreads given that curve. But the 5 and 10-year part of the curve, at least we have some longer term visibility on this. It has shifted, but not as much as the shorter rates.
Okay, Mark, I have a question I think is directed at you. When was the last time cap rates dropped below mortgage rates, and how long did that last?
Oh, gee, I don't know. I'm sorry, I don't know that. Heidi, do you know? You're on mute.
Thanks. When the last time mortgage rates
Cap rates dropped below
Low
mortgage rates.
rates.
Well, certainly it's been that way for a while, at least in the housing market, right? With residential mortgage rates now above 5% and commercial mortgage rates approaching the same levels. So that's something that can persist. I know maybe Simon has some comments about negative leverage and what's happening in that space, but it's certainly something that's not supportive, for future.
Yeah, Heidi, I wish I could share the analysis we're doing right now. But if you go back across various countries, I would say there's been many cases and instances where obviously the borrowing cost was higher than cap rates, and that tells us that real estate is all about it's not a fixed income or straight bond. It's really about the ability, again, to underwrite that growth. And as we said, right now, there's lots of sectors where you can go and unearth that growth. So I would not read those signs of cap rates in some cases being lower than the borrowing cost as any type of signals. But I think it's new given what we've been through. So it was easier, I would say, in the last few quarters to buy at let's say a 4, finance at the 3 and write on it. And just now we just have to do a little bit more homework, but it makes it all so much more interesting.
Growth is absolutely the key, right? And why you're seeing capital go where it's going. It's going where it perceives the strong likelihood of growth. That is type of underlying fundamentals, but that's so amazingly key to the how we underwrite and think about our space.
A little bit of a different question on the industrial front. With the current price of fuel and the rising price of fuel, how has the proximity to rail systems impacted industrial properties? Or I guess what is the benefit to locating near rail systems? If anybody has any insight into that.
I'm no ultimate expert on this one. We do have a vast industrial portfolio, and there is a class of tenant in that industrial portfolio that wants to be rail served and locates in buildings that are rail served, and there's a market for that. I would say that so far we've seen a meaningful difference in the way tenants behave because of rail served, not rail served, or ability of rail serve. And maybe that plays out over a little bit, but we haven't seen any real movement yet on that front.
Okay. On the office front, one of the questions I was interested in revisiting, and we have a question from the audience related to that, was how much repurposing of office space, and particularly lower quality space, there's likely to be, and what kinds of uses will there be? And the question from the audience is actually wondering whether cities might buy older office and retail properties and convert them to subsidized housing. So how much repurposing of office space do you anticipate, and what kind of uses seem the most likely to happen?
I think repurposing can be a great idea in theory, but can be very, very expensive to execute. And I'm not sure that cities necessarily have the wherewithal to do that, certainly not without working with the private sector. I would say in addition to housing, Again, and there are some challenges there just from the construct of floor plates and access to light. Another potential conversion could be to lab and life science, but even there are considerations from stability and floor vibration perspectives, and the need a lot of times to have a lot more attention paid to HVAC systems. So I think conversions in theory look nice, but we've seen very little activity given the level of office vacancy to date. So I'm not so certain that's something that we should expect to see a whole wave of going forward.
And just to chime in, it's just office buildings. Almost any kind of estate that's built for a certain purpose, like malls, for example, we've known for a long time we've had way too many malls, and so why just do something else with them? It's just not that easy. It's really not that easy to repurpose existing assets into other assets. It works in some cases, and it doesn't really work in other cases. So I don't think you're going to see a giant wave either of all of a sudden something being turned into something. It's not easy.
We had a question from a developer wondering, an office developer wondering really what to do now. Should they just put things on pause for now? Because you have to plan a project so far in advance, and there's these questions up in the air about office usage. What's your recommendation for office developers?
Be super careful. My person is, if you have the ability to wait, then waiting's a bad idea. Not everybody has the ability to wait. They have to make a call on whether to go or not to go. But then again, if something I said earlier, you think there's a little window of opportunity to deliver that's competitively advantaged in this environment, maybe that does make sense. That's not going to happen, but there might be certain places where you can pull that off.
Okay, let's touch a little bit on the triple net market, and we had a couple of questions on that. I had somebody asking about when and what the effects will be from rising interest rates on triple net cap rates, as well as how much triple net leases have been impacted by the increase in energy costs.
Susan, sorry. I think Jeb mentioned that it's probably the asset class where cap rates will react the fastest, given the long duration. And I would say the name of the game here is to make sure you have the right rent escalations. And based on what I'm reading, many players in the triple net space are really trying to change the 1.5% rent escalation to more of a CPI plus type index. But it's going to be about are you able to pass on that inflation when it comes? So I think it's going to be definitely more sensitive. I don't know, Jeb, if you had anything to add.
I think that's right. It was that moved the fastest, cap rate wise. The pricing moved the fastest, and rates changed, and transactions slowed dramatically. It is a sensitive spot. Right, landlords love to move from fixed increases to CPI type increases, and it's going to let you do that, and only where so in industrial, that's happening. Actually happening real time. The annual leases and leases getting higher. Some markets being able to get a CPI formula, which has not been the norm. But in other places, you're not going to be able to get away with that. I'd argue that if you're in the office sector of almost any kind, there isn't tremendous pricing power or any pricing power. So you sudden get some more aggressive out of the tenant, pretty weak at the moment. So I would expect that sector remains one of the most sensitive to where interest rates go real borrowing costs.
Okay, I think that because we've only got one more minute, I should just go to my final question and ask all of you, everybody's favorite question, what keeps you up at night? Mark, why don't we start with you?
Well, I'm not going to end on a negative note. No way. I'm not doing that. I actually think there's reason to be optimistic about our prospects going forward. I mean, I listened to the conversation around CRE, and it's easy to be pessimistic about absorption of space, but I always marvel at the ingenuity of the real estate industry, of American business more broadly. We adapt and adjust, and we will figure out new ways of using space. And to that developer saying, hand wringing about whether he should develop, the answer is it depends. Which market, what kind of office building, kind of thinking forward. But we'll figure this out, and I think we'll prevail. So lots of things to worry about, but I think it's at this point, given all the darkness, makes more sense to think about what could go right. And I think there's plenty.
Okay, Heidi.
Well, every optimist needs a pessimist. So I'll chime in on the other side, maybe even away from commercial real estate and the risk that the Fed overshoots and some of the more traditional concerns. I'm worried about domestic issues in the US economy, and I think there's going to be a lot of volatility ahead of the midterm elections. So that's something that I worry about. I also worry from an international perspective, rightfully so, a lot of our attention has been focused on Ukraine. But I worry what's happening behind the scenes with our relationship with China, and particularly the similarities between Ukraine and Russia and Taiwan and China. So those are some of the things maybe away from commercial real estate that have me worried.
Okay, Jeb.
I would simply say what we don't know. I actually, our real estate space is generally pretty good. So I lose a huge sleep over that. But what's the thing we just can't foresee to have a really dramatic change on, but maybe everything. Who would have predicted was coming all of a sudden would have such a dramatic effect on everything? So it's the next weird, unknown, unforeseen thing that just causes havoc that keeps me a little.
Okay, and then finally, Simon.
Look, I changed my answer. Thanks, Mark, for the optimism, but I'll give some hope as well. On our side, I think with everything going on around the world and so on, there's one thing that we should not forget from our agenda is really the environmental and the role we play as real estate, providers and being part of this industry, because we contribute quite a bit to the carbon emissions in the world. So I would say with pricing becoming an issue, with the supply chains becoming an issue, I think we might have a tendency to move that environmental issue on number 3, 4 on the list, but it still needs to remain number 1. And at Ivanhoe Cambridge, we're really focused to be net zero by 2040. So we just hope that all these trends here don't push us off track to achieve that. But it's a great reminder how important this is for the industry.
That is important to remember in times like what we're going into. Unfortunately, we are out of time. We'll be sending you all a link when the recording is available. And we hope you'll join us for our next CPE webinar on June 23rd, Air Quality, the Optimized Office. There's a link in the chat that will take you to more information. And if you enjoyed today's session, we hope you'll be able to join us for the next CPE Voices webinar, or join our upcoming multifamily discussions offered through Multi-Housing News. Meanwhile, I'd like to thank our speakers once again for this very interesting discussion, and thank you all for joining us today.